So it seems to be that the majority is on board here to the call. Welcome again, warm welcome and good morning to our 2023 earnings call. For those of you who don't know me, my name is Hardy. I'm CFO, COO of the company. And before we go into the topic of our today's presentation, I would like to remind you on our disclaimer that the statements that I'm doing here are based on views and assumptions made by the management using information available at this time. These are forward-looking statements by nature, so they are subject to significant known and unknown risk and uncertainties. Please read careful the disclaimer and let's come to the presentation. The presentation is in the 4 different sections. We will start with an executive summary. We will then go into the financials, followed by a quick glance at our share development, and then coming to the outlook at the end of the presentation. And then we have, at the end of the session today, also time for Q&A, and I'm looking forward to have a lively Q&A session after the presentation. Starting with the executive summary and starting with the market environment, and it has been really 2023 a very difficult and challenging year in the market surrounding, especially in North America and in Asia. The markets were very weak. This is due to a backslash in Corona in the vertical markets of consumer electronics, laboratory automation, and logistics. So we were facing a significant down cycle, and this down cycle has been also, or had been amplified in addition by high inventories at our customer side due to exaggerating order behavior in the years before due to the chip crisis in 2021 and 2022. So there was a lot of distortion in the market, and in China, on top of these distortions, we're also facing cancellation kicking in, especially in the first half year, that were to this extent unexpected at that point in time. We come to this later on when we have a look at our bookings and billings development over the course of 2023. All in all, as one indicator here, obviously it's not so easy in our markets to exactly quantify the development of the markets, but one good indicator that we are usually using is the VDMA industry tracker, so the monthly reporting of German vision companies, vision component companies delivering into the world markets. And looking at this German vision components industry, billings were down by 14% and bookings were down by 21%. So a double-digit decline in the market. We come to this also later, and the European market itself was stronger, but especially these numbers here were negatively impacted by the exporting business towards US and also towards especially Asia. So how was the situation at Basler in 2023? It was definitely one of the most challenging years in our history. Our bookings in total were down by 33%, our billings down by 25%. And next to the impact on the top line, we had also weaker gross margins. The gross margins went down to 42% due to low production utilization, consequential effects by the supply crisis because we had to order quite some volume for high prices, and we had high stock then, and we need to eat through the stocks. And we had also quite some price pressure in China due to the high intensity of competition there, but also due to the weak RMB, due to the weak local currency. So we also had, due to this unexpected strong slowdown that hit us during an organization expansion course, we were forced by mid of the year to go into a restructuring, and this restructuring, we entered then into a situation where we reduced roughly our team by 190, 200 employees, and reduced our current, let's say, break-even point down to 200 million euro roughly. With regard to the pre-tax results, we went into a loss of 8 million before restructuring and 22 million including our one-off restructuring efforts. Yeah, with regard to the sustainability, so the non-profit or the non-financial reporting, we made quite some progress on that side. We are on our journey to become net zero emission in the scope 1 and 2 by 2030. We also, have in our aim to significantly reduce scope 3 emissions, but we relate this to sales as we are a growth company. You also will see that, or can see that we made here down on the slide, we made quite some progress on the different ratings with the different rating companies. So we are happy with this progress here, and you can read much more sound information in our newest sustainability report that is available on the website. I mentioned already we were forced to go into restructuring. It was definitely a strenuous process, no doubt about it. You see with regard to the size of the team, you see how we reduced the amount of employees over the course of 2023. So we entered the year with 1,133 employees, and we went out of the fiscal year 2023 with 942 full-time equivalents. As you can see, the split has not significantly changed, so we were able to manage to keep also the balance in the company, even in the situation where we reduced by and large 200 FTEs within just 6 months of time frame. So the company is in a good balanced mode to now shape further and work on the future together. You see a slight increase of marketing and sales. This was by intention, also keeping our front line towards customers strong, and that is definitely paying off. We are already seeing this. With regard to products, we invested heavily also last year in new products. Just to highlight some of the topics here, we invested and continue to invest heavily in our newest platform for the mainstream business, so our bread and butter business and the ACE2 with new features, new sensors, also supporting new interfaces. We also invested in the higher end products that we are offering. The camera line is called Boost, and typically we combine this with so-called frame grabbers, so pre-processing cards that are able to process all the high amount of data that such high-end cameras create. And we also made a lot of progress with regard to our what we call accessories, so the cables, lenses, simple interface cards, and also lighting components. And the real beauty that comes from this selection of hardware products is as you know, our Pylon software development kit that connects all the different hardware products and enables the customer to embed, let's say, the hardware products, the vision hardware products that we offer with his or her system or device. We also added the so-called V-tools, so we are no longer just, let's say, connecting the hardware products, just giving the framework to work. We also offer optionally our customers the possibility to work with our V-tools and solve a vision application. Also on our service offering with regard to the website, we did a lot of progress. We have launched a new website in the second half of the year, supporting our, let's say, full line provider positioning, but also giving the customer a lot of tools in order to select the right products and find the good documentation and support the customer in the selection process and also in the design process of his or her system development. So also on that side here, we did quite some progress. This all in all, is supporting our general strategy. This is a repetition we are continuously doing here, that we are on a journey from the lower left-hand side here of a single component camera company, mainly focused in factory automation or to factory automation. We are on our journey step by step to increase the product line on the y-axis here to become a full line provider and also expand the markets that we address. So this is here from, let's say, factory automation to all in all computer vision. We have already made a lot of progress the last years. We are fully convinced that this is the right strategy for the future. We see there is no, let's say, correlation to the current market cycles that we are facing. That obviously we're much stronger than what we expected, but we are fully convinced about this strategy and move forward strongly on that route. Yeah, coming to the financials of last year, starting with our bookings and billings, and here is a longer term context. What you can see is when we look in the last 2 years, we came from relatively high booking levels, around 80 million, and already in 2022 there was a situation that the order entries went down significantly. But you could also see in 2022 we were able to increase the sales and keep it relatively stable. This was due to the backlog that we had in 2022 and also the delivery constraints that took us some time to clean up this backlog. And then in 2023, when we entered, we still had significant backlog. In the first half of the year, we could also live from this backlog, but unfortunately, what you can see is the order entries went further down. We also got in cancellations in Q1 and Q2 with a sizable amount that instantly also reduced further our backlog. And then we found ourselves in the situation that the markets did not pick up in the second half of the year. The backlog was more or less back to normal, and we had a situation that the revenue went down to a level here of 41 in Q3 and 46 in Q4. This was then also when we were able to see and anticipate what's going on. We, by mid of the year, went into the restructuring. So looking at the different regions, because the market situation was very different. We had a good business situation in Europe. So first half year even we grew by roughly 20%. In the second half year, the European market cooled down a little bit, but we were still making roughly a side move over the course of the year. And we had already a good year in 2022, so the year before. In contrast to this, whole Asia and North America went really into a significant down cycle. The regions were down by more than 30%, those regions. And this also created not only a reduction in top line and in bookings level in total, but also a regional shift. So normally we are quite above 50% with our Asian business. Long term, it's more in the range of 53, 55. This went down to 47. Americas typically is in the range of 20% revenue share, and it went down to 16%. And Europe went up from normally slightly below 30% to 37%. So the European region has made quite some inroads into the revenue distribution and won into this situation. But overall, we ended up with 203 million euro. The year before we had 275 roughly, or 72, so a significant decline. Looking into our gross margins, so you can see here on a long-term track, the last, 8 quarters, it has come down quite a bit, especially also in the second half of the year of 2023. It came further down from a level of 45% before to down to, let's say, 39–40%. This is a blended mix of different effects. We have spot buy legacy effects, we have currency effects, especially in Japan, also from the Japanese yen and from RMB. We have price pressure in China, but we have also significant, especially in the second half of the year, we had significant lower economies of scale in our fixed costs for the production. And we also, and this is in Q4, we had statistical range reductions in our ERP system. So because on a statistical basis, range reductions are done, material is depreciated. As we are coming at the moment from kind of a bullwhip where we have high inventories and a low demand, the statistics are kicking in and material is automatically depreciated. However, normally these materials are not useless. Most of it can be used later, but we don't know when, and because that's depending on when the demand is picking up and the specific material is in demand. So we let the reduction done here. So with regard to the earnings, yeah, you can see the effects of the restructuring in the second half of the year. So we kept the company around break even in the first half of 2023, but in the second half, we aggressively started the restructuring. The majority of the one-off effects we had already in Q3, so with a minus of 16.3 million euro, and then we had another loss of around 4 million euro in the fourth quarter. Yeah, the P&L at a glance here. We talked already about order entries and sales. Gross profit also here went down by 35%, down to 85.7 million. So you see the huge decline here. The year before we had 132 million roughly in gross profit. So there was clearly the mismatch of the size of the organization that we increased and the gross profit that went down, that forced us into restructuring activities. The EBITDA before structuring 8.5, so we kept this positive also after restructuring, but on the EBIT and EBT, you see that before structuring with regard to EBT, we ended up at minus 8 million loss, and we had 20.2 million as we projected, including all the one-off effects of the restructuring. Net income minus 13.8, and then accordingly the earnings per share at minus 45 cents. Yeah, the development of the free cash flow, also here a little bit longer context. The year before in 2020, we had quite some M&A activities. This was in Q1 and in Q3, so there were extraordinary investment. And then in 2023, so we were starting the year with relatively high investing cash flow. You can also see that in Q1 the operating, due to lower sales, the operating cash flow was negative. Also, we got in a lot of material flow in the second quarter. We were able, at least on the operational side, to keep the cash flow positive, but the investment level was higher. So the free cash flow was still also negative in Q2. In Q3, we, let's say, reduced further our investments, and we in Q3 and Q4 we were on, I would say, now the low run rate we run the company with, which is around 2.5 million investing cash flow per quarter. You see that by end of the year we were able, with the reduction in personnel and also slightly picking up revenues by end of the year, also to increase again our operational cash flow. We also in this phase in Q4 were able to reduce our inventory levels. Yeah, having a look at the cash accounts here, or a year-to-year comparison of the cash flow. So we started the year with 28.7 million cash account. We ended up with 32.2. So the free cash flow was negative with 9.2 million, but we refinanced this on the one hand with the increase of debts, but also with the sale of treasury shares, so with using equity by the beginning of the year. With regard to net cash, if we look at the net cash without leasing, it was by end of the year roughly 29 million euro. So the liabilities to the banks 61 million roughly, and cash flow this should be cash and cash equivalents. There is a typo in 32 million. Yeah, with regard to the balance sheet, so the overall sum has been reduced a bit, but not substantially. On the asset side, there were some changes. On the one hand, you can see this is in the fourth line that we have our new building that you now can see in the balance sheet since beginning of the year. So the expansion of the building in Ahrensburg and our headquarters led to an increase in the building here. You can see that we reduced the inventory over the course of the year. There is still more potential, but at least we were able, since we had quite some difficult time in the beginning of the year, in the second half we were able to start reducing our material, our inventories, and also obviously the revenues went down, and so the receivables went down quite a bit. On the liability side, no big structural change with regard to the balance of equity and debts or liabilities, because we, as mentioned earlier, we financed the restructuring by, let's say, additional loans, but also by additional equity by selling treasury shares beginning of 2023. Yeah, let's have a look to the share. I mean, obviously, in such a difficult year, it's no surprise the share price went down significantly from 30 euro beginning of the year, and we ended the year with 11.5. I mean, this is clear. We have to bring back the company to our, let's say, used growth mode. And obviously the share price at the moment is relatively low. With regard to the dividends, yeah, we will propose, so as board and as supervisory board, we have made the suggestion for the main shareholders meeting, and we will propose to pay no dividends for the fiscal year 2023. The reason behind is obvious. We have quite a significant loss in the year, and also we want to, let's say, use all our liquidity and in order to bring back the company to a sound profitability and to a sound growth path. And for that, we decided to propose no dividends. I hope that we get from the main shareholders meeting and also from you support with this decision. It's in line with our dividend policy. Typically, we pay out 30% from our earnings after tax. So we have done this in the last years. There were always some deviations up or down, but this year we decided to propose zero dividend. Yeah, then we are coming to the section which I think is, yeah, obviously of most interest for the participants of this call, to our outlook. So, and how do we see the outlook? So first of all, the assumptions that we are having for this year. We believe that the markets will stepwise recover over the course of the year. It will not be a significant jump. It will be a step-by-step recovery. We believe that the demand is rising gradually over the course of the year. In the first half of the year, this demand will still be muted by excessive inventories. And as we have many customers, it's not that all our customers at the same time go out of their excessive inventory levels. It's a journey where some customers are already out of this excessive inventory situation and others are still in. But we are seeing that this is still impacting the demand in the first half year, but it's slowly getting out of or it's slowly less and less muting the demand. The recovery in consumer and electronics and logistics is expected for the second half of the year. Also here, we do not expect a super strong recovery. We see this more happening in 2025, but we are anticipating that the markets in the second half of the year in those two key verticals for us will recover and will be better than the situation we have seen last year. We believe the geopolitical tensions and uncertainties will remain. We need to maneuver through this. And we also believe the high competition intensity in Asia, especially in China, will also remain, since we have pretty aggressive competitors there and the markets are still very weak. So under these assumptions, we guide for this year a revenue of 190 to 210 million and an earnings margin of 0 to 5%. So our aim is definitely to be in the profitable zone over the course of this year, and be in the range of let's say low single-digit earnings margin, and working full throttle ahead, preparing the company for a real recovery of the markets. And it will be also, this is what we foresee, let's say, happening, a step-by-step improvement, and giving you clear indication for the first quarter. We expect to be here in the range of 45 or a little bit less than 45 million in sales. This is below our break-even point. And the book-to-bill ratio we are seeing at the moment is around 1. So when you compare then the bookings that we had in Q3 and Q4, you see a step-by-step improvement. But unfortunately, the markets are not strong enough at the moment that we will be able in Q1 already to be back in the profitable zone. We also foresee to have gross margin improvements over the course of 2024, and this will start already in Q1. Just a side note from our side, the German organizations, they were in short-time work in the first quarter still. We will also end this with the 1st of April. So in the second quarter, we will have also the full capacity available of the company starting in the first quarter and the 1st of April. How about our midterm plan? We are fully convinced that our markets, the computer vision market, will come back to a growth level of by and large 7-8%, so high single-digit compound annual growth rates. We are also convinced that our strategy is the right one towards the full line provider, the solution provider that I mentioned earlier, and that this strategy will give us the possibility to differentiate better in the market, but also to address a wider market space, a bigger pie, and to create more share of wallet or get more share of wallet of our clients. So with this in mind, we are convinced that we can bring back the company to our growth track that we have shown before. And our aim is by 2027 to reach a level of 300 million euro in sales and to reach this profitable with an earnings before tax level of 12%. So this would then mean to bring back the company to a compound annual growth track of 15%. Also, our cash flow, we guide that we can bring this back to a 70% cash conversion rate before acquisitions. So in order to get there, we assume that the markets at the latest will recover by 2025. And we also assume that at least, having geopolitical stress and also an intense competition in China, this guidance is under the assumption that we have still access to the China market. And given those assumptions, we are looking forward to reach those 2027 goals. And having this said, I'm also at the end of the presentation and would like to open the Q&A session.